Shadow of Truth, and this is episode 11 on Monday, March the 16th, 2015. And your hosts are Dave Kranzler from investmentresearchdynamics.com and Rory Hall from thedailycoin.org. And today's special guest is Mr. John Rubino from dollarcollapse.com. He is also the author of The Money Bubble, which he co-authored actually with James Turt, to something being broken in the background more so than the Austria bank that blew up, and which blew up a German bank, and more so than the situation in Greece. Do you think, Dave, that Greece, the potential for Greece would have triggered anything, or does it actually have to happen in order for that trigger to be set?
Well, I think they're going to keep Greece alive because if Greece drops, it's going to set off. Everyone focuses on what they can see, which is the sovereign debt, 360 billion or 350 billion, whatever that amount is.
Right.
And everyone grabs onto that and talks about it, but no one's been talking about what goes on behind the scenes, which are the OTC credit default swaps.
Right.
Now, those are going to be, I don't know, at least 3x times the amount of actual sovereign debt outstanding because of the leverage involved. So it's 3x to 10x the size. And that's why I don't think they're going to let Greece fall. But I think what happened with that Austrian bank, and then all of a sudden, out of nowhere, we learn over the weekend that a German bank blew up that was connected to the Austrian bank. And the Austrian bank blew up because of its Greek debt exposure. I mean, that shows you how these derivatives can operate. And everyone, even the banks lie. I mean, especially the banks lie about what they have, who the counterparties are, and they're not required to disclose any of that information other than superficial data buried in the footnotes of their 10Ks and 10Qs. But I think Greece has been problematic for them. But the parabolic dollar, the dollar going parabolic, is telling us something happened in the financial world behind the scenes, and I think it might be related to oil. And I had suggested several months ago that oil might be the black swan that everyone's looking for. Not one single Wall Street analyst had been looking for a drop in the price of oil in the middle of the summer when oil started dropping. I mean, it was David Stockman who pointed that out. His quote was, 100 Wall Street analysts all had buys on oil. Well, if you look at all of the fracking and shale oil company related debt that's been issued in the last few years, it's well over 500 billion. That's bank debt and junk bonds. That dwarfs the amount of debt outstanding that Greece has, and those are all companies that are in this country.
Would that possibly be? I mean, could the news of Greece combined with Austrian bank blowing up, combined with the fact that the oil has triggered something in the background, those three working in tandem, that's you think that's what's creating the parabolic dollar, and that's what's sucking the life out of the economy at this point?
Well, no one knows for sure. I mean, Greece is contained for now because it hasn't blown up and it hasn't left the EU, and I really don't think they're going to let it leave the EU. I think everything going on is just political grandstanding, especially on Germany's part, because they know their citizens will scream bloody murder if Germany supports a bailout program for Greece. But I don't think Germany's going to have a choice unless they're willing to let their banks blow up. I mean, the U.S. Let's get something straight here. The U.S. banks have a huge exposure to Greece via OTC derivatives. I mean, I can't prove it, but I guarantee you they do.
Yes.
They're not required to disclose enough information to prove it. But I think the oil situation is far worse. I mean, not only do you have 500 billion in shale / fracking related energy company debt, I mean, you've also got, every large energy company in the world engages in derivatives transactions, hedging or speculating on the price of oil. And to the extent that it's being hedged, hedge funds take the other side of that, or the banks take the other side of that. I mean, for all the OTC derivatives that are probably connected to Greek sovereign debt, I mean, you've got way more than that in oil related derivatives. Just on the 500 billion in fracking and shale company debt. I mean, the first thing a banker does, and I know this because I worked in the junk bond market. When we would do a junk bond deal, the first thing the bankers would do is go to the issuer and go to investors and offer credit default hedges, credit default swap hedges. I mean, and this was in the 90s, and now it's way more prolific than it was back then. And who knows what the real OTC derivatives exposure is to what's happened in oil? No, I mean, I don't even know if the banks themselves know, because they all lie to each other. And they lie to the Fed and they lie to the OCC, which is supposed to be keeping track of all the derivatives contracts that are written.
I mean, I've heard it estimated, that 1 quadrillion in derivatives is not out of the question.
Well, that would be the total
book,
what they call the notional value.
Okay.
And the greatest portion of that's going to be interest rate swaps, which supposedly are all hedged up. But and so when the banks report a number in terms of what their derivatives exposure, it includes what they say are it's net. The number is net of their notional exposure, and they arrive at the net number because they tell the regulators, oh, well, we're hedged on all this. So, for JP Morgan, which has, 65 trillion in notional exposure, and if you go to their balance sheet, it shows they have like 100 billion in net exposure, which is total nonsense. It's just absurd.
That's a lot of leverage.
And I don't even know if it's oil. I suspect that it is oil-related derivatives blow-ups, but something's fueling this parabolic rise in the dollar. And to say that it's because the euro and the yen are crashing, that's too simplistic. Something's causing all of this to happen, and it's not good.
So the question that I would have is, what's causing the euro to crash?
Well, it's the European economy is collapsing.
Well, so is the American economy.
Well, I agree, but again, the media in its Dr. Paul Craig Roberts wrote a great acceptance speech for that journalism award he received in Mexico, and I have it linked on my blog. It's also on his website, and everyone who's listening to this should read that speech because it's called "Truth Is Our Country," and he talks about how the media globally, and especially in the U.S., has become completely controlled by big corporations and the government.
Well, that's been going on for a decade or more, 2 decades or more.
That's right, but I guess what I'm trying to connect here is that everyone, and even colleagues of mine, they call me up. Whoa, Europe's melting down. Well, yeah, Europe's melting down, but guess what? So is this country. So what the U.S. media has done and Wall Street's done is they've focused everything on what's happening in Europe. When the reality is the United States is in worse shape. I mean, every country has a huge amount of government debt outstanding, but no, everyone seems to overlook the fact that this country has a huge amount of private sector debt, meaning corporate and private individual debt.
We do have a lot of debt.
Exactly, and that makes our situation. Yeah, it makes our situation even worse than the average Europeans.
And the student loan debt is actually starting to come apart also at this point.
That's gone parabolic since I don't know, like 2010 or something.
It's ridiculous. I just don't see any of it being sustainable for that.
It's not, and it'll never be paid back.
It'll never be paid back.
Country will ever be able to generate the amount of economic wealth required to pay back any of that debt. Just get rid of all of the debt except the government debt, and we'll never be able to pay that back.
It's mind-boggling.
Yes.
I mean, I don't see how we can get out of it except for a complete change of system. And speaking of which, I mean, Koos Jansen just released a piece this morning called China, Gold, SDRs, and the Future of International Monetary Systems. And that's posted over at thedailycoin.org. And he's talking about China has had an interest in the SDR since 1990, since the 90s, or I'm sorry, since the 70s, but became more, and this is a direct quote from the article, it says, but became more outspoken in 2009 when the governor of the People's Bank of China called for replacement of the U.S. dollar as the world reserve currency by the SDR as to achieve the objective of safeguarding global economic and financial stability. China is currently the second largest economy in the world, and its wishes can ultimately not be denied by other major economies. And that ties into exactly to what we were just saying, to what you were just saying, Dave, as far as how do we get out of it? I mean, do you think that we're going to, that this SDR is going to be foisted upon the world, and that's something that we're going to have to accept as far as global trade? And if so, how is that going to impact the dollars that are currently in my wallet?
Well, anything that removes or even partially removes the dollar from its currency reserve status is going to make everyone in this country less wealthy or more poor. But I don't, again, I personally think that this SDR idea is being thrust at us. It's the media throws it at us. Guys like Jim Rickards throw it at us. And the fact that there's such loud noise around the idea of using the SDR to replace the dollar makes me believe that there's nefarious parties behind the scenes that want to see the SDR, knowing that eventually the dollar is going to be removed. But guess what? The dollar is still something like 40% of the SDR, so it doesn't fully remove the dollar. And I don't know. My personal view is I think that in order to right what's been done wrong, I think we need just a complete reset. Currency reset, economic reset, everything.
I don't really see that happening. Do you?
I don't see that happening either. And again, my default position is this whole thing's going to end up in a global war before someone is able to push the reset button in a way that everyone can accept.
And as far as there being nefarious activity associated with the SDR, of course there is. It's an IMF product. I mean, that in itself tells me that there's criminal activity involved.
Yes,
they are a criminal organization. Period.
If China really wanted to be part of the SDR, then why are they part of a movement to or build a competing organization, whatever that BRIC bank is called?
The BRICS Development Bank?
Yeah. So if they're so interested in becoming part of the SDR, then why are they on this other course? They seem to be on a course where they want the dollar removed completely. And as Dr. Roberts pointed out, it's not clear that they necessarily want the yuan to be the reserve currency.
Yeah, and Rob Curtin.
But that doesn't mean they're not going to roll out a gold-backed currency, and it may become de facto the reserve currency. But I agree with Dr. Roberts' analysis that it's not in any country's best interest and it's not in the world's best interest to have a single reserve currency.
I would agree. I think that those days are long past, and it's caused an enormous amount of problems globally, and I think that's been part of what's opened the door on this floodgate of criminality that we are currently dealing with. I mean, I just don't think that it's done anybody any good except for a handful of criminals at the top. I think that's the only people that have benefited from this.
Exactly, and the SDR, quite frankly, I think is being the noise around the SDR and the movement to push the SDR as the dollar replacement as the reserve currency. I think that's part of the Western, one world, one government movement. And I don't think Russia and China want anything to do with that. And again, I just fall back on the position that if the U.S. dollar as the reserve currency isn't good for anyone except the people who are benefiting from it the most, which are the insiders to the system, then why is replacing the dollar with the SDR as the reserve currency, which is 40% the dollar, and even if they reduce the dollar share of it, if China came in, the U.S. would still have a huge percent of the SDR. What good is it going to do anyone just replacing one reserve currency with another?
Exactly. It wouldn't change anything.
Right, and so that's why I think that this whole movement to thrust the SDR at the forefront as being the best alternative as a reserve currency, I think that's just a Western propaganda campaign. And okay. I think Jim Rickards is the one who leads that.
Well, why don't we bring John Rubino on from dollarcollapse.com, author and wonderful analyst, and get his take on all of this. And
that sounds like a great idea. I'm looking forward to it.
Well, ladies and gentlemen, John Rubino.
Hey, Rory.
Good morning, John. How are you?
I'm okay. How you doing?
I'm doing all right. We have Dave Kranzler from Investment Research Dynamics on the line as well.
Hey, Dave.
How you doing, John? Thanks for coming on our show.
Oh, sure. My pleasure.
Yes. What was happening, John, just before we got you on the line is that Dave and I were reviewing some of the economic news that came out this morning as far as the Empire production numbers and them falling off a cliff and missing everything. But yet somehow the S&P is still up this morning. And gold and silver are being smashed. And just wanted to get your take on what you think about all that.
Sure. Basically, what has happened in the last couple of weeks, last week and this week, is that U.S. economic numbers have been coming out, and they've been underperforming. They've been missing expectations pretty consistently. You know, manufacturing growth is slowing down, and as you said this morning, industrial production is down, and the Empire Manufacturing Survey, which is a forward-looking indicator of growth in the New York area, was also down, or it's slowing. You know, it's missing expectations, and oil is down 4% today, which is generally an indicator of economic growth. You know, in a boom, there's a lot of demand for oil, and the price tends to go up. Well, the opposite is happening right now. And home builder confidence came out this morning, and it undershot expectations. So home builders are becoming less and less confident that they're going to build a lot of houses in the year ahead. So you add it all up, and the U.S. is an economy that's slowing down in most ways. The only positive number that keeps coming out is employment related. And a lot of that is just part-time jobs being added, which don't give the recipients the ability to buy cars or houses or, you know, pay college tuition or anything, really. It's just something you take to survive, and that's all. So that paints an unrealistic picture of the quality of current economic growth. And it also seems to omit all the layoffs that are happening in the oil patch, because over the last few years, we had the fracking boom and general growth in energy extraction. And those are good jobs. You know, a lot of people, hundreds of thousands of people got hired to get oil and gas out of the ground. And now those same people are losing their jobs. So we saw, to the extent that we were generating any good jobs in the last few years, it was mostly coming from energy. And now those jobs are disappearing. So we're back to just a part-time economy. And so we can't trust the employment numbers that are coming out. And these manufacturing numbers are a lot more accurate, I think, an indication of what the U.S. economy is like. And the reason for this is that the dollar has soared over the past year, and which means we're kind of losing the currency war. You know, when your currency goes way up, it's harder to sell stuff to the rest of the world. And that's what's happening to us. We're paying a price for having a strong currency. And it's the normal, traditional, according to the script price. You know, when your currency goes up, your economy slows down as a general rule. And so the question is, how much longer can we take this? You know, can we drop back into recession without taking active steps to make the dollar less valuable? And I would doubt it. You know, we owe so much money that we really can't afford a recession, especially if it brings with it falling stock prices, because that's normally what happens. You know, if the economy starts to shrink, then corporate profits go down, stocks get less valuable, and the stock markets tank. And we couldn't accept that, because that's really the only financial bright spot in the U.S. That we've got this wealth effect going where people's stock portfolios are going up, and that leads them to spend more money, and that might be the only source of consumer spending right now.
Dave, it sounds like he's been reading your mind this morning. So all of those things that you just said, John, are exactly what Dave and I were just talking about. The problems with in the oil industry, the problems with unemployment or the employment, and the parabolic dollar. And Dave, I'm sure you've got at least a question or two for John.
Yeah, actually, I just to add a couple things in terms of the economic reports that had come out this morning. If you look at sort of the subcomponents, really the most damning evidence that we're seeing is the most forward-looking measurements, which would be the new orders component for the Empire State Index, which went into negative territory. It was negative. The index level was negative 2.4. And the industrial production, even though they announced a 0.1% gain from the month before, they had revised down the month before to negative 0.3. So if they had not revised down January's report from positive to negative, this month would have been a very negative, would have shown a very negative number, which essentially tells us that manufacturing, between that report and the Empire State report, it tells us manufacturing is contracting right now. And then the home builder sentiment index dropped, but the worst component of it was the traffic, what's sort of known as the traffic component of the index, which was down to 37, and anything below 50s means that it's bad. Now, Bloomberg attributes this to the fall off in the first-time buyer, but if the first-time buyer isn't buying, it also means that the move-up buyer can't buy because they can't sell because they sell their house to first-time buyers. So there's all the data this morning, I think, sort of reflects an economy which is not just slowing down. I think we're heading into a contraction.
Yeah, the first time buyer thing is really interesting because that it fits into the two-tiered economy story, which I think is huge from both an economic and a political standpoint in the U.S. The rich are getting richer at an accelerating rate, and the rest of us are being squeezed. And at the entry-level home buyer level, these are people who maybe just graduated from college or just got out of high school and got a job, and none of these guys are making the kind of money that their parents made at the same stage of life, and they also owe a lot more. If you get out of college and you don't get a very good job and you have massive student loans, the last thing you're going to do is go out and buy a house, right? And the last thing anybody's going to lend you money for is to buy a house. So we're basically impoverishing a whole age category of people, and we're paying a price for it because, as you said, you don't get first-time home buyers in the market, and then you don't get move-up buyers because the people with entry-level homes can't sell their houses in order to move up, and so you basically freeze the real estate side of the U.S. economy, and that's really what's happening to an extent now. With interest rates at this level, any other time in American history, we would have had a raging home buying mania right now. 4% mortgages, forget it. We would have had soaring home building, soaring home buying, people moving up and flipping and doing all kinds of crazy things. It would have been more extreme than in 2006, and yet we're not having that. And the reason we're not having it is because interest rates aren't the only part of the equation. If incomes are incredibly low at the lower end of the economic spectrum, then that freezes the housing market, and that's what we're seeing. So there aren't simple fixes with monetary policies the way there used to be now, because we've got these structural problems, and it's not clear to anybody in charge, I don't think, how you fix these structural problems, because really the only tools that they've got that in their theoretical framework that actually work anymore are lower interest rates and debt monetization. And those things have proven to be incapable of restarting consumer spending and home buying and the other things that we depend on for growth.
Yeah, I would agree with that. And in fact, the government has started to intervene again with their taking the down payment requirement with Fannie and Freddie to 3%, reducing the mortgage insurance premiums with FHA sourced loans. And also, I just discovered this recently. There's a 0% down payment program sponsored by the USDA, and it's supposed to cater to rural home buyers. But what they define as rural is basically includes outlying areas of suburbs around most major metropolitan areas. And so even these new government subsidized programs they're not stimulating home buying in general, but they're not stimulating specifically first time home buying. And I think that's what they were targeting when they put in the new mortgage guidelines.
Yeah. Well, we're doing what we can to increase speculation out there. And,
exactly.
And that would never be a good thing. But it's easy to understand why they're trying it because they really don't have much else. They probably learned the lessons of the past housing bubble bursting, but are abandoning those lessons now because they're desperate. If consumers if people aren't going to malls and buying stuff, and they're not buying houses, and now they're not buying cars, that's been the big growth area was subprime auto loans in the past year, and now car sales are starting to fall off the table. What's left? If 70% of the economy is driven by consumer spending, and consumers really aren't spending on anything, then you're looking at a really serious problem. And these guys are doing their best to head it off. So I think one thing that's fairly certain now is that the Fed is going to be in easing mode a year from now. They might try to raise interest rates one time, which I think would be playing with fire here. Who knows what the stock market would do if U.S. interest rates started to go up. But if they do try to raise interest rates one time at this meeting or the one that follows, I think they'll have to reverse it back out and then start instituting dramatic cuts by the end of the year because the economy really does seem to be slowing down. And as I said, you can't tolerate a slowdown when you reach a certain point of debt. We just owe so much money that we're incredibly unstable. And any kind of a garden variety recession, which would have been just a blip 30 years ago, is a life-threatening experience now for not just us, for the whole world. Europe can't drop into a recession. Japan can't handle a recession. China, who knows? Probably not. And so the whole world has to intervene in the financial markets, doing whatever it takes to keep stocks from tanking. You're seeing the Japanese central bank intervene aggressively in Japanese stocks right now. And the European Central Bank is pushing up stocks within the Eurozone by pushing down the value of the euro. And now the US is going to have to do something similar, assuming that we're not already doing it, to keep US stocks rising in the face of a soaring currency and possibly higher interest rates. They're going to have to do something really experimental and really extreme if they want to maintain a bull market in equities while this other stuff is going on. So, all you can really say about the year ahead is that it's going to be volatile. It's not going to be a stable time, but in what way the volatility manifests is pretty hard to predict given all these moving parts.
There is a lot going on, and I wanted to ask, you had mentioned the currency wars, and you just mentioned the euro and the yen. How, as far as the dollar going parabolic and the euro falling off a cliff, the yen falling off a cliff, I don't think that the Federal Reserve or the raises interest rates, I don't think they're ever going to raise interest rates. That's my personal opinion. I don't think that they can. I don't think they ever will. With the euro falling off a cliff how is that affecting us here in the States, or does it have an effect on us here in the States?
Oh, it has a huge effect because we trade with Europe. So whatever they're selling us is priced initially in euros, which means it just got cheaper by maybe 30% in the last year. So their stuff is on sale. Okay. Meanwhile, our stuff, what we're trying to sell them, has just been revalued 30% higher. So our stuff is much more expensive for them. Their stuff is much cheaper for us. And so, basic economic theory says that we'll buy more of their stuff, they'll buy less of our stuff. And so trade balances will shift in their favor. And that means they make more money. Their corporations report higher earnings. They presumably hire more people. And in general, their economy grows relative to ours. Now, the Eurozone has so many other structural problems that the cheap euro is just one of their issues. And that's a positive for them. They've got a lot of negatives at the same time, where some of their constituent countries are just taking on mountains of new debt. Italy's government debt is soaring. And Greece is already more indebted than anybody else as percent of GDP, except for Japan. And Spain is a mess, and France is both a mess economically, and they're on the verge of electing an anti-Euro party. The National Front in France is leading in public opinion polls right now. Yes. And one of their platform planks is to take the French out of the Eurozone, go back to the French franc. So there's a lot of stuff going on in Europe that a lower euro helps, but doesn't completely fix. And in the U.S., we felt like we were in relatively good shape for a few years, and that was because the dollar was cheap. We were winning the currency war coming out of the 2008-2009 collapse because we jumped on the QE bandwagon earliest. We started monetizing our debt before anybody else and increased the size of the Fed balance sheet, which is to say we pumped a huge amount of new currency into the economy. And so we had growth relative to the rest of the world. We seemed to be the world's success story. But that was because the dollar was so cheap relative to the euro and the yen. And now we've reversed those factors. And you would expect Europe and Japan to do relatively well. They've got other problems, like I said, so they're not going to do great, but they should do well compared to us. And that's the way it's playing out. Our numbers are consistently undershooting expectations, which means the economy is slowing down and in danger of tipping into a recession now. So, that's exactly what you would expect theoretically from a soaring currency. And so we're getting it. At least that part of economic theory still seems to work. We're kind of violating a lot of the other supposed laws of finance, but this one seems to still be having an effect.
I'm just curious as to when the economic laws are going to step in and take charge, because it seems like the theories are all working, and all these PhD economists have run the entire globe into the ground, and their experiments are just not working. They just don't work regardless of what they try and of what they say, and things get worse instead of better. And the economic news that we received this morning is proof positive of that. And you can't paint those pictures into truth. They don't lie. So, that's just the way I see it. So I'm just waiting for the economic laws to rear up and take charge again, because they will.
They always do eventually.
Yes.
And one of the things about bubbles is that they seem to defy both logic and economic laws for a long time. The big bubbles of the past 30 years have all reached the point where the critics of the bubble have been silenced because they had been wrong for such a long time that people started making fun of them. And so you hear the critical voices start to drop away. And that's one of the ways that the bubble is getting towards the end. But, tech stocks should have stopped going up in 2008. Valuations were already historically crazy by that time. And they made it all the way to 1998, not 2008. But they made it all the way to 2000 before that bubble burst. And, that the housing bubble in the U.S. I wrote a book about it in 2003. It was obviously a bubble then, and the bubble went all the way to 2006 before it started to roll over, and 2007 before it burst. So this is like that, only it's a global bubble. James Turk and I, in our latest book that we co-wrote, call it the money bubble, because it's a bubble that encompasses fiat currencies and government bonds globally. And so the fact that it's global instead of localized in one country or another implies that it can go on longer than other bubbles. And it really has. It should have burst before this based on any kind of reading of what rational analysts would call economic laws. That there's a zero bound for interest rates. You can't push interest rates down below zero. And yet we're doing it. There's a lot of things like that. You can't borrow more than 110% of GDP if you're a government. Well, we're lots of countries are doing that, and they're just blowing right through those limits. So
you could argue even the U.S. is beyond that now, because you have to throw in the Fannie and Freddie debt that the U.S. now guarantees.
Oh, yeah.
That's $7 trillion. That takes the U.S. debt load up to $25 trillion.
Sure. And unfunded liabilities of Medicare and Social Security take it up to what? 150 trillion.
Yeah, but those are kind of soft. They can always be changed with the stroke of a pen. I mean, the Fannie and Freddie debt's already out there and issued, and other people hold it. You know what I mean? The rest of the stuff is sort of future promises.
Well, but those are promises made to my generation, the baby boomers,
right,
for our health care. And I think we won't let the government change that lightly. It'll probably be a lot easier to stiff China on our treasury interests than it will be to stiff baby boomers on their health care. So a lot of that stuff is baked into the cake. It's a real obligation, even though we don't define it as debt officially. It's something that the government is going to have to come up with money for in the not too distant future. Boomers are retiring now, and we're using serious health care. And we will continue to use serious healthcare for the next 30 years, as we go from 65 to 95 and expect to be taken care of that whole time. So anyhow, this stuff, leaving the definitions of debt and derivatives and unfunded liabilities aside for a minute, we've reached the point, no matter how you want to define it, that we've reached a point that shouldn't have been reachable. We shouldn't have been able to get here without having some kind of massive crisis. And yet we have. So that means the question is, what is the limit? And we don't have any kind of theory now, since our theories have been exceeded for telling us where things start to blow up. And so I think it's almost random in the future now. We can keep going for quite a while, as long as everybody will accept these currencies, and as while no big bank gets into trouble with its derivatives, or no country like Greece defaults on its debt, but let something blow up out there, and then the whole system will unravel. So, it's like Jim Rickard's mountainside with lots of snow falling on it. You don't know what snowflake will cause the avalanche, and there's nothing special about that particular snowflake. But once you create the conditions in which an avalanche is likely, it's going to happen eventually. So I think we're there now. Some kind of global conflagration where the whole financial system just goes up in flames is out there somewhere. We've created the conditions in which it's not just possible but likely, and now we're just looking for catalysts. What's going to be the thing that blows up the system? And there's no way to know that ahead of time. But it's
interesting, John, because before you came on, Rory and I were talking about that, and I would actually argue that the collapse in the price of oil is your black swan.
It certainly could be.
People in this whole conversation that everyone has, and I think it's kind of directed by the mainstream media and Wall Street, no one talks about OTC derivatives. We don't know exactly what they are, where they are, and how big they are, because the reporting on it is so opaque. And I would say, outside of interest rate swaps, I would bet that oil and energy-related OTC derivatives are among the larger sector of derivatives issued out there. And I actually think that the dollar going parabolic is reflecting some sort of financial fire behind the scenes. And I almost would argue, I believe that it might have been set by this collapse in the price of oil.
Yeah. I totally agree that this is a big wild card out there, because we just don't know who has what in the world of derivatives and who's on the hook for what. And you know, at the same time, the dollar in its own right is a potential catalyst too, because so much dollar-denominated debt exists out there. There's something like $9 trillion of U.S. dollar debt outside of the U.S., and a lot of that was taken on in the last couple of years for, you know, carry trade kinds of investments, where you borrow dollars and then you go buy Brazilian bonds or whatever. You make the spread and you do well as long as the dollar doesn't spike. Well, the dollar has spiked, and so we're likely to see some of that blow up in the year ahead, but we have no idea what, where, or when. And so, you know, it's possible we get a confluence of stuff where some oil-related derivatives blow up, and then some dollar-related carry trades implode, and lots of things start happening at once, and the markets just get overwhelmed by the serious-sounding bad news out there. So instead of little stuff like the Austrian bank, for instance, that just went bust, and you know, it's going to cost some German banks a few $100 million euros, and maybe lead to a bailout of a province in Austria. You know, we might get something bigger than that, where an entire government becomes insolvent because of loans taken out imprudently, or some major bank blows up. And that's when things spin out of control, you know, and that's what we saw in 2008. You know, we saw major financial institutions start to lose it. And it wasn't just one. It was one, and then two or three more popped up, and then it was clear that if we didn't resolve those two or three, the whole global financial system would collapse. And it happened in the space of a few months. You know, we went from being fairly healthy in 2006, where you had talking heads on CNBC saying, oh, you know, everything is healthy, our monetary policy is great, and we've outsourced our monetary policy to China, and they're taking care of it for us, and housing is strong and will continue to be strong. That was 2006. And then by late 2007, the whole world was falling apart. So, you know, we could see the same thing here.
Now, and this kind of ties into when you and I spoke a couple of weeks ago, John, we were talking specifically about the bank in Austria. And I'd ask you about if there's a way that we can see the fuse being lit by these derivatives now, with everything that you just described that happened in 2006 and 2007 and 2008, with all those derivatives being blown up. And is that what we're seeing right now with Austria, as far as this bank in Germany blowing up over the weekend?
Well, there are derivatives associated with this process, but we don't know. Nobody will tell us where they are.
That's right.
Because they're unregulated. These guys don't have to say what they've got, because what a big bank does is it might have trillions and trillions of dollars of derivatives, but it nets the long and the short ones out, and then comes up with a net number that it reports as its derivatives exposure, and the net number is minuscule compared to its real exposure.
Yeah, you say net, I say random.
Yeah. Because what happens is with these things is that, you know, if you're hedged, if you're on both sides of a derivatives trade, you can think that you have zero exposure if you want to think that. But let one of the counterparties default, and then all of a sudden your gross exposure becomes the real exposure, you know? And that's what happened in 2008 when Lehman Brothers tanked and AIG was on the verge of tanking, and all of a sudden Goldman Sachs and JP Morgan Chase were bankrupt because the other side of their derivatives didn't work anymore. So they were just stuck with one side, and the one side was blowing up. And so, yeah, that's out there as a possibility, but we won't know until they tell us. You know, there's no way an analyst can get the information and run the numbers and say, oh, yeah, these guys have a $4 trillion liability that is going to come due at the end of the week, and if they don't solve this problem by the end of the week, they're going to blow up. We can't do that kind of analysis because those numbers don't exist. And so we'll only know afterwards when the financial markets are in turmoil, and then we find out why. It was because Deutsche Bank's derivatives book blew up. Well, by that time it's a little bit too late for us to do anything about it.
And the whole world is on fire economically.
Yes.
And we've been speaking with John Rubino from dollarcollapse.com, and he's the author, co-author with James Turk of The Money Bubble. And you've got a couple other books out there, John.
Well, yeah, James Turk and I did a book called The Collapse of the Dollar and How to Profit from It a while ago.
Yes.
And I've got a book on clean tech, on solar power and alternative energy and stuff like that, called Clean Money. And I'm at work on a proposal for another book, which I'll tell you about as soon as it starts to happen.
Okay, that sounds great. And John, I certainly appreciate all your time. Dave, we will talk with you soon. And gentlemen, you guys have a good afternoon.
Thanks, guys.
Sounds good. Thanks, John.
See you, Dave.